What's up everybody, Nate here, and over the last week or so we've actually gotten some really good news and some really good data about the future of our economy and our current economy, and I want to take a minute to kind of go over all of this brand new data and news. So the first thing that we need to go over is GDP. Now, GDP has kind of been a sensitive topic in the United States because in Q1 of this year we actually saw GDP decrease by 1.6%, and then in Q2 it went down by an initial 0.9%. Now I say initial because this was the very first reading. The Labor Department and the Bureau of Data that actually collects these numbers, well, they actually look at our GDP 3 times over 3 separate months. The first look that we got, GDP shrank by 0.9%. That was back in July. But as of last week, this number was actually revised, and it was revised downward. It went from around a shrinking of 0.9% down to 0.6%. So we are still seeing that GDP decline in the US, but it's actually going down, and it looks like that might get revised downward again, although it really could go either way by the end of September. Now, this is a really positive thing for our economy because it shows there's a lot more spending for both businesses and consumers, and the biggest takeaway from GDP actually declining a lot less than what we thought is that the Federal Reserve won't have to do as much to kind of get our entire economy back on track and lower inflation. Since pretty much March of this year, the Federal Reserve has launched its war on inflation, raising its interest rates and reducing the amount of bonds and assets it's been purchasing with its quantitative easing program on Wall Street. And of course, it's pretty much shut the money printer off. So it's been printing a ton of money through stimulus and of course a lot of other programs, but that money printer is pretty much turned off now. The big worry though is that the Federal Reserve, because inflation is so bad, they're going to have to get really aggressive with inflation and raise their interest rates really high, basically eliminating all demand in our economy. So there's just not going to be as much money circulating around, and people are going to have a lot harder time buying things and spending on credit cards and just getting debt in general. That can hurt our entire economy because with people not spending as much money, businesses don't really have that money to spend to pay their employees or hire new ones. So that's really bad, and it leads to kind of a spiraling effect where now people don't have any money because, well, they're unemployed. That's really bad for our economy. But with our GDP actually not going down as badly, the Fed won't have to do as much as they would have before. At least that's the theory. Now, the second thing I want to talk about comes from that spending. So GDP actually isn't declining as bad, and that means that businesses are still spending a lot of money. And where are they spending money? Well, they're actually spending money in their employees. We got the most recent numbers for the JOLTS report just a few days ago, and this basically showed that businesses are still looking to hire a lot of employees. Job postings are increasing, and there's still about 11 million job postings available in the United States, with around 5 million or so people unemployed. That actually jumped up a lot from June to July, so businesses are not being as hurt right now by Fed interest rate policies. One thing that really hurts businesses because the Fed is raising their interest rates is that people are not going to invest as much money into these businesses. They can't take on a loan, so it's going to be a lot harder for businesses to grow. On top of that, sales are down, so that really hurts businesses a lot, and that means that a lot of businesses are going to have to start cutting people in order to make profits and actually start making some revenue back with inflation going up and their costs starting to rise. But interest rates going up have not hurt them as much as people would have thought, so they're still able to hire people, and they're still able to, well, give out bonuses and raises and continue to post new job listings all throughout the United States. That's a really good thing for our economy. And again, it helps the Federal Reserve to kind of figure out what they're doing with their monetary policy, because by theory, if everybody in the United States is employed, then everybody is getting a paycheck, which means people can still buy things, and it doesn't really matter how high you raise your interest rates. With inflation starting to come down, which it did in July of this year, that means that the Fed is still on track with its monetary policy. And this new jobs data eases a lot of stagflation fears throughout the United States. Stagflation is basically when inflation goes way up, but your economy is actually starting to shrink. We are seeing that a little bit throughout the country, but not as bad as many people would have thought. Because businesses still have a lot of money, that means they're increasing their inventory. That's part of the reason why we saw GDP shrink in the first quarter of this year, because businesses were improving their inventory, meaning they were buying a lot of things to meet demand here in the United States. And of course, we had a lot of supply chain issues, so they had to do that all at once. Now they're still able to do that because they have the money to do so. They're going out and buying things, and people can go to stores and purchase things again. We don't have a lot of those supply chain issues like we did in 2020 and in 2021. Of course, there's still shortages of a whole slew of things all throughout the country, but things are slowly starting to get better. And this new jobs report shows that there's a lot of unemployed Americans still. Now, at face value, that looks really bad, but in reality, that means a lot of Americans still feel like the jobs market is in their favor. They can go out and get a job and get a better pay raise just by switching positions right now. So they're kind of waiting things out to see what happens in the future. That's why there's still so many job postings. But for businesses, this is pretty bad because they still need a lot of employees to help kind of mitigate a lot of those supply chain issues. Now, I will say a lot of these businesses are posting jobs, but a lot of Americans don't want to fill those positions. So we're probably going to see some pay increases or some other types of benefits go up for people to go out and get those jobs. The jobs market is still really tight according to the Federal Reserve though, because quits are actually going down because of the Great Resignation. Basically, employees had all of the power in the relationship, so they could go out and get any job they wanted to for better pay, better work-life balance, and better benefits. That is slowing down in 2022 as there's just not as many jobs as we saw over the last couple of years. And people are not sure what's going to happen with our economy, so they're slowing down quitting as well. The other thing to note here that comes off of jobs is actually consumer expectations. Now, this is really important for the Federal Reserve too, and our entire economy. How do people feel about a recession? How do they feel about inflation? If people are really scared about a recession, then they're not going to go out and spend money. They're going to save money. Same with inflation. If people feel like inflation is going to be really bad and entrenched deeply in our economy, then they're not going to go out and spend a lot of money. They simply can't. But according to the University of Michigan Index for Consumer Spending, this has actually gone up in July. So people are feeling a lot better about our economy, although it's still at a near record low for confidence. A few months ago, consumer confidence hit the absolute floor, lower than it's been since the Great Recession. But now it's slowly starting to go back up. So people are feeling better about our economy, which means they're going to go out and spend, they're going to take on debt, and all of those things grow our economy and hopefully keep us out of a recession. Which brings me to my last point is fewer and fewer Americans are reporting that they're living paycheck to paycheck. Now, many Americans live paycheck to paycheck still, around 59% of them, but this number is down from 61% from June to July. As inflation went down in July, mainly due to gas prices and energy costs going down throughout the country, many Americans had more money to spend on other things that are going up in price, like food and shelter costs. So what exactly happened here? Well, costs in general have slowly started to come down. Like I said, particularly energy costs have come down, and many Americans spend a lot of their money on energy. But many Americans also have gotten pay raises over the last couple of months, whether that's from their current job or by switching positions. So some Americans are earning more and they're spending less on some things, which means there's fewer Americans living paycheck to paycheck in general. Living paycheck to paycheck can be really dangerous, especially in this economy, because we don't know what's going to happen next. If we do start to see massive layoffs and unemployment, then many Americans are going to immediately be in financial trouble. And literally, they are one financial emergency away from having a disaster. So the fewer Americans that are living paycheck to paycheck, the better. That means there's a surplus in a lot of these families, and that means they can start building wealth and putting a lot more money back into our economy. And if fewer and fewer Americans are living paycheck to paycheck, along with consumer sentiment going up, that's a really good sign for our economy because it likely means that inflation has finally peaked. If inflation has finally peaked, well, then we know that the Federal Reserve isn't going to have to be as aggressive with their interest rate policies. So we could see fewer interest rate hikes in the future, and they could be a lot smaller. And they actually could reverse a lot of their monetary policies, stimulating the economy sometime in 2023. But like I said, inflation is a general number. It's a lot of different things, and some things are still going up in price, like food and shelter. Energy did go down in July, but that is just one thing. So to say inflation is really going down at this point, well, I'm not really convinced. Overall, though, this could lead to some short-term relief for a lot of Americans, and it comes at a really good time considering the Federal Reserve is raising their interest rates and things are getting a lot tighter in the labor market. That short-term relief could turn into some long-term gains depending on which direction our economy actually goes in. But now I want to hear from you on this issue. issue. What do you think about all of this actually good news about our economy and the future of our economy in 2022? Do you think our economy is headed in the right direction and it's going to get a lot better and healthier sometime soon? Or do you think all of this data is just an outlier and our economy is actually going way down and will continue to do so for the foreseeable future? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can sign up for it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.